everyone. Thank you for joining us today. I think we're all here to hear from the experts in the space. As we all know, AI is constantly evolving, so bear with us as we share learnings as well as our journey in learning about where the regulations and investment thesis could be. Maybe to start, I'll hand it over to Ed to kickstart this conversation. So, being an investor in the early stage startup space, what AI startup, what is the definition of an AI startup that's investable for you in 2025?
Okay. No specific definition, but maybe kind of like a vision of it, the shape of it. At the core of it, product market fit still matters, like for any great startup. It's just that with AI, there's some unique dimensions. We look for a team with technical fluency in regards to large language models and how it can be applied effectively. Are they looking at, are they using prompts? Are they doing fine tuning? Why? What are they labeling and what are they not labeling? This is interesting. And so they should be able to reason through it and talk about trade-offs. Because these are strategic decisions that require deep understanding. We also look at its position, the product's position, and whether they'll be able to kind of build moats. Is it going to be able to collect proprietary data? Will they be able to embed themselves into the customer workflow? Is this infrastructure that people will rely on? So in short, it's not just about bolting on GPT into a UI, but to actually have deep insights on the market, model, align the two together with intention.
That's very interesting. I think we have another early stage investor on the panel as well. Do you have anything to add on to kind of your definition of what makes an AI startup investable in 2025?
I do think that so when we look at AI company, right, it's shaped a very different new way of doing company, right? So when we see AI native company, it's probably similar when you see in 2015 everyone is building mobile app, right? Now I think when a company says that they're AI native, it means that they're building something in a whole different way. And it happens in many shapes and forms. So when we see, for example, one of our portfolio in Europe, Lovable, for example, right? Within 2 years, 60 million ARR. Like, never happened before, right? And then we have another portfolio company in Singapore, Farmia. Within less than 2 years, 3 million ARR. And with less than 10 people in the company. So when we look at AI company, we look at it from a very open-minded point of view. We just knew that we're not an expert in this. It's very hard to be an expert in this. I feel that unfortunately today there's a bit of the blind leading the blind condition with an AI. But overall, when we're looking at AI company, we do look at it from this is something this is a different breed. And we do a lot of we spend hours and hours actually studying it and actually understand how it is, understand what is technically how this can happen, right? Why is this just a wrapper? Why we're doing this in one infrastructure? Why an MCP is needed there? Why is an agent there, right? And then how do you see this from a domain expertise perspective, for example, in healthcare? And so I think when we're looking at the AI company, we try to let go of the old thinking because I'm coming from, I'm quite old. I've been in the ecosystem for a while, so I kind of let go of all the e-commerce, all the SaaS,
the traditional
mindset, and try to look at it from the AI company. Because what we want to see in the AI company is hyper growth, and what we want to see is very capital intensive, capital efficient company. And that's already happened in small form, and we believe that we're going to see that more and more, especially in SEO.
Actually, on that point, very interesting point. Maybe I'll throw it over to Nafas on capital efficiency. Right? We've gotten a bit of perspective on early stage definition of investability, but from your perspective, when you're looking at more mid-market or growth stage tech, what does that look like for you?
So, it's very interesting for me to hear the early stage investors give their perspective, because we're at that stage where AI has started becoming, making sense for the market, right? From product market fit, you've started generating, you've seen companies starting to generate revenue, and when it becomes interesting for a growth stage investor is when the revenue gets to a certain scale, and when they want to really like grow that revenue even further. So obviously, as alternative investments from, let's say, a private credit player, what we get to see are two kinds of opportunities, right? One is related to infrastructure, because AI is an infrastructure heavy technology enabler, right? So there is all these kind of data centers, or even companies that want to actually buy NVIDIA chips so that they can basically like try and do this compute themselves, etc., etc. But then again, to the point that many of these companies are also becoming leaner and leaner, which means they're letting go of their R&D, which means that their burn is going down even further. So they're becoming closer to profitability, which was a bigger question mark when all this capital was being thrown around in 21, 22, right? So I think what we see, or we haven't seen yet, but what we see a lot is existing companies trying to reinvent themselves by using AI. So the journey towards profitability is now becoming more reasonable with them actually using lesser R&D to actually scale there. Well then, these are probably companies that are planning for IPO, and they're saying, hey, now we are using AI to actually reduce our R&D, so burn has come down. So this makes a lot of sense. AI native companies, we haven't started seeing, at least I haven't started seeing a lot of AI native companies, at least in the region, that is at a scale which is of interest to a growth capital player. But in the coming months, or coming maybe months more rather than years, we'll definitely see some of them, in my opinion. Yeah.
Very interesting. I like how you mentioned infrastructure specifically, but maybe just a question to anyone else on the panel. Within the region, do you see more investment opportunities into the different layers and different components of AI? For example, middleware or application base that kind of sets the region apart from, I guess, outside of APAC?
I'm going to try to answer that questions, but maybe just to give a more context from our firm as well. And I think in terms of the investment strategy to AI particularly, we've been still researching about it, and I think so are the other firms as well. So no one within the VCs or PE has been really making a further move on this, I believe. Please correct me if I'm wrong, but I think in terms of like infrastructures, in Southeast Asia or like Indonesia particularly, I think what we want to make sure in looking at these AI companies are more towards on like how they can execute, like how can they operate this AI model in the right manners. I mean, like we want to look at their governance, we want to look at their approach in like making that happen, whether they have structured process if they want to change their business models, whether there is like an agent in the company that can lead these transformations, whether there is a specific, let's say, head of AI or like a center of excellence that sits in the decision maker, so then the CEO can communicate that there will be a transformations in the entire business, in the entire company. So I think that's what we really look at when we analyze the companies. And the other about infrastructures, maybe this will be a bit technical, like the quality of the data, the quality of the infrastructures. I think the cybersecurity aspects, the compliance aspects, the legal aspects. In our firm, I think if you don't have the enough capacity and expertise for that, we will definitely get another vendor or like advisors who can advise us on that aspect, right? And I think the other two that is very important to mention is also the current capabilities of the team members. So like whether they have the right talents and skills to actually implement that, whether they can upskill or like upgrade themselves to be able to work with that efficiently. I mean, like if there's change management happens in the company, do they have the right mindset to shift that the business is changing, whether they can have the right behaviors to cope with that changes, right? Whether whether the product that you deliver to the users, or even the business process that you do in making your business, right? And the last thing maybe to emphasize is on the operational efficiency part, because I come from portfolio management, so I look into this domain a little bit closer. So I think we want to make sure if they really have a good project management systems, whether they have even as basics as communication, right? If like this change is to happen, whether the CEO or like the executives are clearly communicating it, that it will be part, like it will be integral to what they do every day. So I think that's what I observed that might be overlooked by these startups. That is like that is like experimenting with this AI capabilities in their companies.
I was going to ask you too, Bob, because within the same vein, you look at what is purchasable, right? Upon exit, advising for M&A. So how important are the things that Tricia said about, these things not to overlook or neglect in a startup?
Yeah, thank you. Yeah, I might have a different angle from the other panelists. I think I'm not the only venture capitalist here. Looking from the M&A perspective, I come from the M&A landscape. Usually we start from the end. We always ask whether this startup or this company will be acquirable in the next 3 to 5 years. If they are acquirable, then it's time for us to invest. But if it is not, then it's not yet investable. So looking at the startups, of course, we have to look at the solvability. So that's the main thing. So the startup has to really solve the real life problems, not only the technology. So really addressing the real life problem. And then secondly, we also look at the possibility whether this startup or this model can be scalable, because there is no point to invest in one startup, solvability good, but there is no scalability. And the last thing, I think this is also very important from the M&A perspective. Lately, we are looking for sustainability of every startup. So the viable business models has to be in place. We try to focus on the bottom line, we can say, not only the upper line or the top line, because in terms of M&A, we have evaluations, methodology, multiples. Some startups, we always use the top line multiples, revenue multiples, GTV, GMV, but for the more growth companies, we go to the bottom line, which is EBITDA multiple. So now there's quite a shifting from where we look. We don't only look from the top line, but we also have to understand the business models, the viability, the profitability of the business.
No, very, very good points. And actually with that, I'd like to segue to our next question of how do you balance between the need to invest into R&D in a very rapidly, where I guess innovation is almost like a commodity at this point. It's a given. For AI, you need to build fast. There needs to be new features, new functionality. How do you balance that with profitability? Maybe I'll start with the portfolio management side a little bit, because that's when like the efficiencies have to kick in, right?
Yeah. Thanks, Stephanie. So I think we've been working with some, if not many, of our portfolio companies trying to transform themselves as well with these AI capabilities. I think maybe if we were to draw like which verticals, I think financial services has been quite a forefront on which domain that is able to adopt this. I think if we break down their business processes, right, we want to map out the quick wins within the business processes that are that have potentials for automations or AI, and that's when it happens, I guess, kicks off. So starting for example, like maybe the customer service that naturally sound very manual, so they start with that, trying to develop or like maybe could join with like a vendor that is able to provide streamlining capabilities with the AI. So being having someone 24/7 for the customers to deal with the complaints and all that. So that's one aspect. The other thing I think the other thing is also about their how they use the data for maybe better decision makings. I guess in the company in financial services particularly, we have a view lending platform, credit lending, which has been able to absorb that capabilities as well, and then has been able to improve their business operational efficiencies as well as hopefully can unlock more revenues for them. But other than financial services, I think we also see transformations or experimentations in the SaaS platforms companies. Maybe that's given the more familiarity the team has with the technology, maybe it's easier, more natural for them to apply such change. So they do that. They try to, maybe they start from a SaaS platform catering for a restaurant business, but now they found a gap between for like consumer lending, in which they try to tap into as well from the data. They use AI. They can identify the credit scoring, and then they can actually fill in the gap to channel their financings into those companies. So I think those are like the examples what I've been seeing in our portfolio companies. Does that answer your questions?
I think in broad strokes about like what areas can be optimized to balance profitability and innovation.
Yes. Sorry, let me answer that. To balance, I think our simple approach would be to start small with the quick wins. And I think we want to encourage them to have a specific timeline, usually. So like within 6 months or like 12 months, throughout the milestones, we want to be able to reach the other one only if the one pilot project is successful, basically. So I think that's like a simple approach, which I think is happening.
Can I add something? So I think that the whole market already shifted. I believe that like talking about profitability and being sustainable, everyone already have
it's
that.
A given.
It's given. It's given. And one of the biggest things, or things that we see are very different, especially with like AI enabled or AI based company, is that is high margin business, right? The moment that is a high margin business, it's a whole different DNA than the e-commerce. Like me, sorry, I used to be a B2B e-commerce founder, small margin, very hard to be profitable. Eventually, when we're there, but it's still very hard. It was very different than if you're doing like an AI a software company or a service company with 90% margin, right? Then even hitting your 10K, 20K ARR, MRR, that's already close to breaking. So because of the margin profile is different, and because of that value added creation or value creation is different, and then how efficient the team are, or like how efficient the capital are being used, it create a very different model. So we have to use that model in mind. And I think when we're talking about sustainability, we already have a couple of models. We have a couple of portfolio companies in our company that easily profitable with a different margin profile. So I think when we're talking about like AI company, I think it needs one of thing that's I keep finding out. The DNA is like it's high margin. It's a minimum SaaS margin profile with high added value, right? And with that kind of condition, I think really would believe in me, would agree with me, right? Like 70-80% margin, it's not very hard. It's very different than like single digit margin e-commerce company, where we have to like work very hard, cut down costs, and be efficient and whatnot. And especially in these days, like when you look at like so many different, let's say for example, an AI-enabled company that are doing procurement. We have that company in Singapore and Malaysia. Almost no operating costs, and then they benefit. They're benefiting by like GPU costs going down, LLM costs going down, the whole token costs going down, from GPU to TPU, like all this investment that people in the valley does that makes the cost down. It's adds on to our margin. So we are riding that wave, and if we're able to ride that wave, able to go into the market, find a product market fit, a good profile margin, manage the operation costs into an area that is also manageable. I think being sustainable and profitable should be a question.
Yeah, just add a little bit, talking about profitability and R&D innovation. With AI now, actually the cost of R&D is going infinitely to close to zero, or like some really, really ridiculous low amount actually. With a small team of 2 to 5 people thinking together very carefully, we can get a lot done. So even the R&D aspects, the profitability of these things, it's going to increase. And with these like software plays, AI, there's a real opportunity to just make a product and go global with it. We don't have to think so regional. The world is converging in our behaviors and our trends, so there's a real opportunity. So it's exciting times.
I'd like to add a point there, sorry, because maybe my perspective is slightly different because I'm also looking at what's the downside scenario here. I completely agree that yes, for some AI native companies the profitability is really high, but I think from the investor's perspective, I think AI has grown to a level where it has become a transformational technology, foundational technology, where it's going to affect not just companies that define themselves as AI native companies, but also existing companies that define themselves as Web2 traditional companies. They're all going to be affected, right? The question is how fast and at what scale. Now, does that change how an e-commerce business will do its business is a good question, because I have a company, and I wouldn't name the company, but then it's invested in by Google, etc. And then they were never an AI native company, but then they were having like a few $100 million of revenue, and then with all this new wave, what they decided was, they will go into using the AI technology to make shopping experience much more automated, right? Without in a different way, and these kind of customer acquisition strategies burns a lot of money, right? So maybe they're not burning money in terms of developing, but then they're burning money in terms of acquiring those customers. Also, if you look at some of the AI foundational technology companies that are developing the generative AI technology, and unfortunately in Southeast Asia, I don't think there are many, but there are few, but not many. They're burning a lot of money because these are essentially capital intensive business models. So the question is, I don't believe all companies will naturally become profitable. There's also a possibility that the whole world of venture ecosystem of venture investing is going to change, because you have somebody who's launched, the founder of Revolut, if I'm not wrong, has launched a fund, a $200 million fund, without any analyst. It's just him and the AI, right? So the question is, hey, then entry-level jobs for VCs, is it under threat, right? It's not just VCs, it's also entry-level jobs for developers is under threat, right? So the question is, you have all these technology companies that are going to generate, let's say, more revenue per employee. So it is probably the winners are going to be really good targets for venture investments. But then venture investment is naturally a product which has been built on this concept that you lose money, so we give you more money, and then you basically deploy that money and make money going forward, right? So if that concept of giving money and you growing at that aggressive pace is lost, then is there a concept of venture investment? So I believe it will always come to that stage. It will be like, there will be definitely some companies who are going to be outliers, who are going to be profitable from day one. But I think a lot of the companies that are going to do meaningful work because of AI is also going to lose money. The question is, what is sustainable in that? Because ultimately, venture investment involves 95% of the company's failure, right? So this is the natural way how venture investment has worked until today. Will it change? It can. Will it change for good? It can. So I think anybody who's in this space needs to have all these things, considered in perspective. I think one thing Southeast Asia has to work on a little bit is to also develop a little bit of foundational technology. I think the DeepSeek movement was really good because you had all the development happening in US and the Western countries, and then suddenly you had an Asian company outpacing them to develop. Right? Can we develop this in Southeast Asia? Is a big question, right? Technologies that can be competing at that level, but that requires a lot of compute power, right? That requires a lot of space. That requires a lot of energy. These are big question marks. Or do we just end up creating what you can call as applications on top of these foundation layers, which is no way is bad, but just may not be there's no reason why one big player need not come in and take from your business in the future. So these are questions that needs to be answered. Very important for us to be mindful of all these changes and try and adapt and help the companies through this stage. Very interesting to see who are going to be the winners. Probably the next Google of Southeast Asia or the region. So it's a big question mark. I don't know if there is anybody right now, but it's going to be interesting for us for sure.
No, I think that's very interesting from the perspectives that have been shown so far. I mean, just how you open the panel up of like, you just have to be open-minded when it comes to AI, not just from the startup end, but also from the investor end, right? And different stages of the company, and depending on what type of AI company, that may warrant for different types of capital, whether it's venture debt, private credit, venture capital. I think let's just stay on our toes as the space evolves and then learn from each other as well. So very good points, everyone. Did you want to say something? Yes. No, I think maybe just one more question on the concept of capital. From your perspective, because I think within the VC space now, there isn't just, or in the startup space now, there isn't just, AI native companies, right? So companies that enable AI to make their operations more effective or efficient. Do you see this as when you're looking at a company, is there an initial range that you have in mind when it comes to targeting burn, right? And this kind of relates to type of capital you take on. Since we have so many different types of investors on the panel today, just wanted to see what's your take on, when you see a company, maybe it's not necessarily a bad company, but it's not the right fit for your type of capital class.
So we are in private credit, right? Obviously, in our world, we give money to a company with the idea that we will have the company repay us that money either through the life cycle of the facility that is provided, which is usually 3 years or 4 years or 5 years, or it's a big exit event, either an IPO or an M&A. Let's all accept the fact that unfortunately the exit environment in the market in Southeast Asia is really not great right now. So I think what everybody, at least people like us, will always be looking at is this company going to be able to generate positive cash flow? And the company is never generating positive cash flow unless it is gross margin positive. And I think that goes back to the point that was mentioned earlier that maybe the gross margins will improve, and if the gross margins improve, that means probably some of these targets can become more interesting. There is a larger question around, if you're going to invest in infrastructure, the pace of the development of the technology is so fast that is the NVIDIA chip that these companies buy today still valuable 24 months down the line? It's a big question, right? Which is why you will see players like NVIDIA trying to also buy and have control over the software on which these developments happen. So I think it is important to understand what we are financing, at least from our perspective, what we are getting into, and it will also go. It will also depend a lot on the sponsors, which are the venture capital, right, the private equity world, how they think about it. Do they believe in these numbers? Because they are the ones who are actually giving them legs to actually reach to where they let us, and then we give them further legs to actually get to the finish point. So I think that's going to be starting from how the VCs think about it, but ultimately, at the end of the day, it has to generate value not just for us, but also for the VC community. That's the simple thing. I think as a business, as a business policy, it hasn't changed. We collect money from people, we give it back to people. So there has to be this circular. Otherwise, it doesn't work.
Oh yeah, just to add. So yeah, target burn. Never really thought of it in that definition, target burn. But I guess naturally in the business of investing, there is a sense of like, I'm gonna invest in this. They will spend the money, and the money's gonna come back, like you mentioned, right? So there is a sense of okay, we're spending this, we're not profitable, but we can see where it returns value. Margins might improve, or there might be growth, and this will set them up nicely, and they can always become profitable when they want to. Case in point, a lot of these subscription products burning money, but the moment they say, you know what, I need to be profitable, the behavior is sticky, right? So even the burn there is a visual of like what the goal is, and depending on the investment situation, the industry, or even the vertical, yeah, sometimes the burn changes. Like we come in and say, okay, 2 years, 3 years of burning, no problem. Actually, make it 5 years. Actually, be profitable, or maybe go faster. So it really depends on cost and benefit analysis. Yeah.
Yeah, so probably I want to add something that is maybe a different point of view altogether. Is that I think we're looking at it from like a FOMO perspective, because typically first money, right? So we are probably the most FOMO investors. From the FOMO perspective, is that we typically see. So what happened, right? If you look at like venture deals in general, there's a more dense number of people, right? Meaning that less deal, bigger capital, right? And what happened there is that like there's a lot of fights in Series B and Series C, right? And allocations has become harder and harder. And we double click on that. What happened there is pretty much like, hey, you know what? We don't know about this company, and then suddenly this company within 6 months grow like really crazy, and everyone is fighting for allocation, right? So in general, when we look into what happened with capital profile and company profile, and the connection between those two is what happened is we do see that great company, let's say they're struggling in the beginning, trying to find product market fit, and then raise a little bit of money, but then suddenly find something, become very efficient, and suddenly it's booming, right? And then that create a very different funding rounds than the typical SaaS, right? So we don't want to miss out. So that's the reason why I think we keep investing in AI company. So I think a couple of months ago there's a article saying that Antler is the most active AI investors globally. That's not intentional. That's purely because we're super curious about AI in general, and there's no way that we can learn about AI without investing. So I cannot just like, hey, study and like read all the white paper.
Right, we're on this journey together. It's still ongoing.
Yeah. I have to go like, okay, let's invest. It's good money. Let's see what happens. Right? We have to actually do that. So with that sort of like mentality and being a bit vocal about that, then we understand that the pathway of funding rounds is also very different. So and then also that also in our return profile at the end of the day. So what happened is probably outliers gonna be the bigger spikes in the future, but fewer wins in general, right? So we're probably gonna invest in 100, 300 companies in our fund, and probably see 2-3 outliers, right? And that's fine because the outliers spike is higher, and with our entry price, it's fine.
Yeah, I think if the audience hasn't figured this out already, we're very fortunate to get sources of capital from many different areas, and each one of us is kind of tasked by our LPs, our investors, with the capability to make decisions based on, what data points we have in hand, right? And each of us have very different return profiles, so there's no right or wrong answer. It's just like what is right for that point in time.
Sorry, may I add a little
Yes,
bit
of
on
course.
that? So I think from AC Ventures, if you guys have heard about the company, I think when we started back in 2018, 19, we started to focus first on the early stage, right? So maybe those you know about investment, you can a bit predict on like in terms of the ticket size, your questions, Stephanie. That's when we started. But I think what I wanted to share is maybe similar to other VCs or like PE as well. In this climates, we also have been evolving as a firms in terms of looking at the investment strategy, which sectors we are looking at, like this years and last years, even as the size of our investment tickets as well. So maybe we are more open towards like early stage to grow to even PE size of investments, and that would include AI sectors in our strategy as well. And I think second point that was discussed about the burn, based on my observations, if it's I don't know, maybe from coming from a portfolio management again, right? Seeing how it's actually being implemented, maybe when Ed says that the cost of like experimenting about technology and like risk R&D will actually come to a very lower cost or like maybe nothing. I think that would be ideal that would be ideal. Maybe it's happening as well. But in terms of like an even early implementation, maybe we will have to be a bit more flexible. Again, the mindset, maybe Agung said that as well. Maybe more open-minded about AI, because what I understand personally, if it's like maybe a more straightforward SaaS, then ideally, if you already have a product market fit and then there will be like a recurring business, you should be able to like stabilize your company, and then it will be like getting your returns as you expected. But then when you add AI capabilities experiments in the middle, then I believe there's going to be hiccup, right? It's like even within a quarter, 3 months, that discussions with the management, with the BOD, with the investors will actually go around, and then to make sure that it's actually a mix, like an investment that makes sense for the company. So I think about the rate of the burn and on that aspect, I think that's what I can share. Yeah.
Thanks, guys. I think maybe just a segue to our last question. I'll start with Mulyadi first, especially as you're the closest to exits. And so because you deal a lot with brick and mortar companies as well, I think when you consider investing in tech, especially innovative tech, there's always that regulatory component that isn't fully baked out yet, right? Sometimes for when you think about crypto, when you think about AI, and to a certain extent fintech, not so many years ago, regulations were still being formed. What considerations do you take into account when you look at a target acquisition?
Of course, the lens is very different from the venture capitalist perspective. So, from the private equity perspective, we tend to invest in company which is more mature, we can say. Regarding the regulations, we want a company who is already do all the compliance, yeah. So every risk has been taken already. So they try already to do a lot of iterations, yeah, go to the market, and then usually what we expect is a company who can do partnerships. So this is one aspect probably what we can say, partnership with a bigger company. So let's say a fintech company, if they can work together with big banks, go into their workflows and so on. So I think it will also
take a very good aspect for us to look at. But again, at the end of the day, even though we still try to understand about the founders as well, yeah, because we sometimes we say we also have to understand their interests, their patience, and their willingness to learn. So those are the things that we try to look at on the regulations wise, especially in the AI driven. So AI is data driven, right? So there are a lot of the data is a lot of regulations and that, especially for the personal data. So we have the undang-undang PDP in Indonesia, we have the GDPR in Europe and some other countries. So we want to invest in a company who already go through this process. So that's the risk assessment that we have to. So it's the one tick mark. If there is no tick mark of this, then we won't go to the other the other list. So that's the first list that we want to make sure.
Add something. So as a it's not typical for early stage VC to have an exit. But we have an exit. We have a DPI. Have our LP, and Pandu and Adrian is also our LP. So we're very proud that we have an exit, and we've been doubling down and actually try to understand what's an exit look like, right? Because this is a company that we invested in 2019, and then several years later become $1 billion exit, right? So we kind of actually look at it like what happened there, what's actually makes an actual exit in a tech company. So we understand there's three things. One, multi-market. So apparently, tech company that are doing one single market having a hard time in exit in general, because you have one directional exit. While if you're a multi-market, you most of the whoever the acquirer or whoever board your big listed that has seen you as a multi-market company, right? So as an international global company, so you have a very different valuation, you have very different credentials and whatnot. So multi-market become very very important. This is very different because like if you remember, I remember myself 10 years ago, we want to build Indonesian company, blah blah blah. But then at the end of the day, multi-market become very valuable. Two is a business mode that are very very deep. So it's always so this is a company that are doing something. So they're first mover in many ways, right? So because they're a first mover, they also make a larger margin in general. So and then because they are larger margin profile, first mover have their own defensibility and moats. Their closest competitor is probably 1/10 of their size, right? And because of that, exit become very very interesting as you might, because like when they're doing when an exit comes, comp actually there's a lot of like comp analysis happening, right? And when comp analysis shows like outlying spike, it becomes super obvious, right? And then the last thing is also ability for a founder to how to say this to create an organizations that are professional. I think this is something that many founders doesn't have in mind when they're first started. Like when they're building a company, everything's just like very messy. I did that myself back in the days, and then as the exit come, right, and then it becomes one of very important things. You want to see what happened 5 years ago, right? You want to see who's signing this, who's signing that. You want to understand. You want to do a DD on the vendors, DD on future customers, a DD on the partners, blah blah blah. And unfortunately, this one is something that many founders are not putting enough effort. So one of the biggest thing that I learned as a startup founder, I used to be a startup founder, is that we didn't hire a CFO fast enough. And that is it's me by being too frugal, but end up suffering at the end of the day. So I think getting like so one of our company at the end of their exit, what they do is hire like a very professional CFO who have ability to actually see this as a more organized corporate structure. So hopefully that helps. You want to see it from 0 to a million.
So I think we're out of time, but obviously there's so many more points that we'd love to chat with. These panelists will be here afterwards, so feel free to reach out to any of them. But that brings us to the end of our panel. Thank you so much, everyone.